In Davos, you had quite a week, I guess, right? With talk about targets and your earnings. Is there something that investors did not understand? Is there something that you want to tell them right now?
No, actually, well, I think by now probably they understand that the biggest issue was about our new targets. I think investors did understand that we had to revise them down because they were set in late summer 18, and based on a totally different macroeconomic underlying assumptions. But what was not understood was the fact that we presented a range, and we said our target is the top end of the range, and the 12% has to be considered a stressed outcome in a very particular stressful situation. And people confused and wrote about our new target being 12%, and that's
so you're
not
aiming
correct.
for 15%.
Just to our target is 15%.
Okay, you're also focusing on more cost cuts. What does it mean for job losses?
Well, we have been taking out 900 million of cost on a base of around 24 billion in 2018 last year. We took down 2.7 billion of net cost. I'm always talking about net since 2015, and while reinvesting in infrastructure, in technology, in regulatory requirements. So we constantly look on how to optimize our platform and our capabilities. But we are not there just to cut costs. We want to grow. We want to grow also our business and prepare UBS for the next decade.
One of the most difficult ratios is cost to income. How can you do better on that?
Yeah, the cost-income ratio is an important indicator for us. Is a totally misleading indicator. Structurally speaking, we are in a business that has a higher cost-income ratio. We don't have a very large commercial and corporate banking business that sustain a group-wide much lower cost-income ratio. So we offset this higher cost-income ratio with a high efficiency on how we deploy capital. We are the 5th best bank in the world in terms of return on regulatory capital. Okay, so which is very important for us because the noise that we have in our tangible book, because we have a lot of deferred tax assets and we pay only once a year our dividends. So there is a big gap between tangible and regulatory capital. So as long as we trade at the high end, after the few American banks, we are the best non-US firm, and there are 1 or 2 other US firms behind us in terms of return on capital. So that those two ratios needs to go together.
Do shareholders understand that?
Some of it, yes. Some of them, they still need to really analyze this issue. But particularly, I think that is more some other commentators that they really don't want to listen to that. They look at the cost-income ratio per se as an indicator of inefficiency, and is not correct.
Talk to me about the French case. Do you know how that will go? What's your hunch at the moment?
No, I don't know how it's going to go.
Okay. Are any further share buybacks contingent on
that?
No,
I think that, of course, the French matter is an important decision point for us in respect outcome in respect of how we're going to implement our capital return policy in the second half of the year. For the first half of the year, we say that our aim is to buy back more than half of what we did last year. Then we're going to wait the outcome of the French trial, which may come late summer, early autumn, and we will reassess the situation, knowing that we are starting the year in a very strong capital position. We have 13.7 CET1. We have 3.9 leverage ratio, a total leverage ratio of much more than 5%. So we are in a strong capital position, and we need to see how the French matter goes.
At the moment, is it impossible to have a hunch of the way that the French matter goes?
No.
Why? Yeah, it's a trial.
Because it's a trial, and I think that the outcome of the first round was totally disappointing and not really expected. So we need to just focus on preparing for the appeal.
So what will you do with the investment bank? You said you're not happy with the way it's going. What will you do about it?
I'm not happy about the way it went. 19. So if I look at the average return on the investment bank in the previous years was anything between 11% to 15-16%, on average 13.7%. The investment bank has to go back into at least low double-digit return on allocated capital. It's an essential part of our value-added proposition. UBS is not the sum of the part of 4 businesses. UBS is an integrated bank, and and our IB has to contribute with a strong return on its capital consumption.
But that means what? Restructuring?
No, I think it's just focus. I mean, of course, there is an element of our business mix and strategic choices we made about not being in certain businesses. We have a geographic footprint that is more skewed towards Europe and Asia rather than the US, which was the most performing market in terms of M&A and fees last year. But over time, I'm convinced that we can go into the double digits by just having a more normalized environment and a sharp laser focus on execution.
When does a normalized environment come? And we're just hearing from President Lagarde, negative rates aren't going to stop being negative anytime soon.
Yeah, but for us, normalized doesn't mean necessarily negative rates or not. It's a little bit more volatility in financial markets. Of course, we are working on cost. We are working on how we use our financial resources more effectively. Last year, we took down, for example, out of around 900 billions of LRD, of balance sheet, 30 billions in efficiency on how we run the same resources in a more efficient way. So we constantly look at different levers. There is not a single magic action you can take to fix or to adapt to the new environment.
I feel like every year in Davos, I ask you whether we're going to see consolidation in the banking sector in Europe. Is 2020 the year?
And one day is going to come. and actually, as time goes by, we're getting very close to that moment. And I do believe that the second half of the year is going to be a very important moment because you're going to see the finalization of the Basel III, Basel IV rules on how they're going to get implemented in Europe. That's before that or after that, you may start to see people really realizing the need of offsetting shortage of capital with combinations, and I think it's a necessity for Europe. It's not a matter of if, is when and how and who, and it's not if this should happen or not.
But is that really a catalyst?
Sorry?
Would that be really a catalyst for banking consolidation?
No, I mean already today, without any further developments in that sense, you have an issue of critical mass, focused critical mass. So I'm not saying that scale per se is the solution, but you need, when you are focused and when you have capabilities and you are good at, you still need scale. No matter how good you are positioned in the competitive landscape, scale matters. Scale allows you to create the resources not only to offset margin compression, but also to deliver better and pass it to clients. Is also to deliver the savings to have an attractive capital return and to reinvest in the future.
Okay, so is there something? Would you be part of this consolidation if bigger is better?
Nobody can afford to say that is not part per se of a consolidation process. We don't need per se to do consolidation, but we have to consider all the time, and it would be as part of our job to always look at potential combination that creates client, and also at the same time shareholder value.
Okay, but would this be in Europe consolidation, or would you also look to expand the US?
We can't really define our flexibility and ambitions narrowly, so we can look at any element that creates, as I said before, shareholder and clients value.